Hi, this is Brennan Decima, owner of Decima Wealth Consulting. Today we're going to discuss asset location and making sure that we have the right investments in the right account. With investing, it's not always about what we make, it's about what we keep. So the way that I like to think about this is designing a house. So we can build a beautiful home and we can buy all the best furniture, but in order for that house to function appropriately, the right appliances and the right furniture needs to be in the right spot. So for example, you buy a beautiful dishwasher and matching fridge and matching stove, and you throw those in the bedroom, and you have the most comfortable king bed and it's in the kitchen. It's the right stuff, but it's in the wrong place. Investing works exactly the same. You can have a really good investment, but if it's held in the wrong account, it can dramatically change the return profile. So let's think about this. There's really three types of accounts. We've got brokerage accounts, we have qualified accounts where things are tax deferred, and then we have tax-free accounts like Roth. So let's just kind of think through this. A qualified account, so a 401k or an IRA, the benefit of this is that you do not pay taxes annually on the interest, the dividends, and the earnings. So in tax-deferred accounts like 401ks or traditional IRAs, this is really where we want to put our high dividend stocks. This is where we want to put our high interest bonds. So things like junk bonds, things like corporate bonds, high dividend paying stocks, real estate investment trust, they pump out a bunch of income and they really make the most amount of sense in a 401k or an IRA. And the reason for that is that income is not on your annual tax bill. And when you withdraw from the IRA, it's taxed as income. So the huge advantage of this is controlling when you receive that taxation. So if you are getting a ton of dividends, so let's just take Pfizer, for example. Pfizer pays a 7% dividend. Well, if it's held in a 401k and you get that 7%, you're not taxed on that dividend until you need to spend that dividend. So you're taxed when you need it. Well, the next bucket is a non-retirement account, a brokerage account. And this, you've already paid taxes on the principal, but any interest, dividends, and earnings is added to your annual tax bill. So let's say you're in your highest income years. You're going to retire in a few years. You're an executive getting all kinds of company stock, and you keep that stock in the brokerage account. So let's say you have that same Pfizer stock, it's paying you 7%, and you just reinvest it. Well, that's going to be added to your annual tax bill. You're paying tax on money you don't need. So you could have that exact same investment, but if it's located in the 401k or the traditional IRA, you're avoiding the taxes in the year where you're a high earner. If it's in the brokerage account, you're not avoiding it. So what makes more sense in the brokerage account? This is going to be index funds and ETFs, so anything that doesn't pump off a ton of interest and dividends. Stocks that are a little bit more volatile, because keep in mind, in a brokerage account, if we do end up having a loss, we can do some tax loss harvesting, use that loss on our tax form to get a credit. But there's also an advantage from an estate planning standpoint. So in a brokerage account, let's say we have something where the returns come more from capital gains and less from dividends and interest. So let's take NVIDIA, for example, next to nothing on the dividend. Well, let's say NVIDIA over the next 20 years doubles or triples, maybe even more based off how NVIDIA has been going. Well, if you have $1 million and it turns into $2 million, $4 million, and it's in an IRA or a 401k, all of that is going to be taxed to your spouse. All of that is going to be taxed to your heirs. Whereas if you have that exact same growth position in the brokerage account and you pass away, there's a step up at death. Your heirs and your loved ones receive that tax-free. So growth potential, when it doesn't produce a lot of income, really makes a lot of sense in that brokerage account. If we do want to hold bonds, things like muni bonds where the interest is tax-free, it makes a little bit more sense. And then the final bucket is the Roth account, the tax-free account. And this is really where we also want high growth investments or active mutual funds where there's a lot of high turnover. Take some of the best performing mutual funds over the year. You've got things like Fidelity Contra Fund, or you've got the American Funds Growth, where they've dramatically outperformed the market. Well, those mutual fund managers are buying and selling stocks. And at the end of the year, there's capital gains distributions. Small cap funds and international funds tend to have a lot of capital gains distributions at the end of the year. They make a lot of sense in the Roth because you have the high growth potential, but you also don't have that capital gains distribution being added to your annual income. So again, you could have a really good investment, but if it's in the right account, it can change your take-home return dramatically. So if you find this helpful, please hit subscribe. If you'd like to learn more, please leave a message in the comments. And as always, thank you for tuning in to Decima Wealth Consulting.